Welcome back to Primary Source China Investment. Pungo and I are here with show 04. And this week, we're going to talk about debt. We've talked about debt in the past, and we've talked about the investment thesis, but we're going to break it down into a couple of topics today. The first is to size China's debt. It's truly staggering. At last measure, debts of all sorts, public, private, in all sectors of the economy, amounted to the equivalent of about 52 trillion US dollars, almost 3 times the size of China's economy as measured by GDP. This is the highest level in the 27 years that Beijing has been recording this. So what does that mean? And what is Beijing doing about it? And there's actually a lot. And some of those topics we've seen before. The first up is property. Pungo and I have talked a lot about this, and recall months ago, Pungo said, and I agreed, that the property sector would not be a Lehman moment for China. And that's largely been true. But the property sector was hit hard. Residential sales are at 5-year lows. Recall the solution when some of these big names went belly up. The market solution was to have big state-backed property companies acquire the unfinished projects of the private developers. In reality, many of those private projects were not up to the standards of the large SOE developers. So they just died. I mean, you can go Google YouTube videos of unfinished buildings being collapsed. So the state-owned enterprise didn't get into those really bad deals, but they did take the opportunity to pay down some debt, which was offered through some kind of bank lending program. And that's probably why you see the equity values in these property developers looks like they've bottomed. Pungo, any thoughts about what we've seen in the property market as a result of the last 12 months or so?
Property market is still digest the loss for the previous years, but the hardest time probably already passed, and China just clean up entire the real estate market. Finally, they figure out the entire China have the 600 million buildings, not a unit for sale, it's buildings. That's a lot. So
that's a lot of supply.
People are just waiting for, is that a property tax will come out, or they have the different way to do it. Shenzhen already started the innovation way to add the probably 300 million unit supply in the market. So they really try to reach the goal. Real estate is just for living, not like the speculation. So that's the basic goals. And people still be waiting for the property tax. That is a really big deal. And how and which city they probably do it. Right now, with the economy recession, China still faces the local government is still facing lack of the physical resources. Property used to be the cornerstone. But right now, they try to still promote real estate is still cornerstone.
Well, you have
to find alternative ways to do it.
Yeah, you also have the consumer. Property used to be a one-way ticket to wealth, and now people are realizing that
that's a complete change. So everybody's expectation completely changed. Yeah.
So that's going to dry up a lot of demand when a lot of supply is already sitting out there. So there's probably a little bit more pain to go, but certainly the worst is probably in the rear view. Let's see how it develops going forward. There's no guarantees of the future.
That's right.
So the next up is something we visited early on in our program, which is the Belt and Road, and I think it's going to be recalled the bonds and repricing, because according to aid data at the College of William and Mary, around 60% of China's overseas loans went to financially distressed countries in 2022, compared with just 5% in 2010. So unable to pay China back, some of these cash-strapped governments are pushing for debt release, forgiveness, or restructuring. We even talked about Sri Lanka's port back many, many months ago. And that's already received a 2-year reprieve of interest. Zambia is in default on 17 billion. Pakistan owes 30 billion. As Pungo said more than a year ago, the biggest loser is the entity making bad loans. And in this case, it's China. But China's also changing, as well as offering fewer loans to Africa. Instead, they're going to nearer countries, fresh commodity sources, and places where Chinese firms are able to dodge Western trade tariffs. Malaysia and Indonesia have benefited because of their proximity. Latin America, because they have a lot of, it's a mineral rich environment. So even Xi Jinping said, small is beautiful in 2021. So it looks like the Belt and Road is changing. We have a lot of legacy debt that's on the books. A lot of it's not going to get paid off. We're going to see how it gets restructured. But going forward, all of the Belt and Road seems to be a lot more localized and a lot smaller in scale. Pengwo, do you see the same thing, or do you feel like it's?
I think basically it's really like the global economy, and also it's pretty much like the emerging market debt or bond, some things. All those loans, I personally feel is more like the project financing. So it's based on the individual project. All the major economy entities fall in the trouble. Obviously, the emerging market get hurt a lot. So they just lack the abilities to pay back. So while the long approach to the termination date, or even like the cash flow, they probably still have difficulty to produce it. I think that's really like the plus with the Federal Reserve increase the interest rate. So a lot of things, it looks like it's a bad signal for all those loans.
Yeah, I think they're getting smarter too. Beijing is certainly going to learn some lessons. If you just give out tons and tons of money and the business case is sketchy at best, and then those projects don't produce. There was a project in Laos, for example, that cost $4 billion. There was just just doing quick math, there was no way it was going to be able to pay back. Not necessarily.
That's exactly. So, but at least such a huge amount of money they put out to all those countries. They did change their economy. If without those money, they probably still back or even get worse. So you think about it, without this project, they suffer this global recession. So they cannot get better. So.
That's true. They'll probably be. There's 100 PhD students right now working on thesis to tell you if Belt and Road was a net positive or a net negative. I'm sure there will be many papers coming out.
That's right. So I think it's more like the global problem for those projects. So I think from China perspective, China really believe peace brings money, but unfortunately, due to global recession and many other political reasons, the may or may not get continued. So it's hard to see with that. But definitely, if war was spread out and cause them more problem, I think they will get much more trouble in the next step.
Absolutely. So finally, what does this all mean for the average investor looking at renminbi denominated debt? We always have to circle back to the practicality of it. So we have CBON and there's KBND, which is another small ETF that's based for US investors. And they're flat to slightly up year to date with annualized yields of 2.57 and 2.40 respectively. China's 10-year rate is at 2.94, up 10 bips from the beginning of the year. And RMB is at about 696 with some small depreciation and then appreciation back since January 1. So small move, some small moves during the year, but about where it was at the beginning of the year, RMB dollar. So that's about it this week for Show OW. Thanks for tuning in. We'll see you next week.
Thank you.